In early 2026, economists expected a smooth glide path. The global economy was widely projected to enter a period of post-pandemic stabilization, with key markets finally returning to a predictable, steady recovery. Then, two major shocks hit simultaneously. The outbreak of war in the Middle East at the end of February collided directly with a harsh new wave of U.S. tariffs on consumers and trade. This collision accelerated a trend known as geoeconomic fragmentation. Instead of trading freely, rival political blocs are actively erecting walls and dismantling decades of cooperative global trade to prioritize their own agendas. This chart shows exactly how geoeconomic friction hits the wallet. After a baseline of stability, two lines, representing energy and food costs, violently spike. These are salient prices, the highly visible, everyday costs that dictate inflation expectations. The Middle East conflict drove both of these up across the globe. As the chart splits, the data reveals a stark divide. Advanced economies experience a bump in costs, but commodity importing emerging markets face a severe downward trajectory in purchasing power. They're hit with a devastating cost of living squeeze, compounded by depreciating local currencies. Market efficiency has taken a backseat to national security. Reliable global supply chains have become systemic liabilities. To quantify this damage, the International Monetary Fund ran a structural stress test on the global economy. Their latest projections lay out three potential futures, and all of them warn of impending stagnation. Their reference scenario assumes a short-lived conflict, dropping global growth from a historical 3.7% to a sluggish 3.1%. If oil shocks persist, it drops to 2.5%. Under a severe stagflation scenario, the gauge plummets red, slashing growth to a mere 2%. Under any of these three projections, the traditional safe harbor of the U.S.-led economic system will be pushed to its absolute breaking point. Historically, when global panics hit, nations and investors flee to the ultimate safe haven, the U.S. dollar and American debt. But that haven is exposing internal vulnerabilities. The United States is carrying record-high public debt, and increasing political friction is actively threatening the independence of the Federal Reserve. Add in the aggressive use of tariffs and international sanctions, and rival nations are increasingly treating the dollar as a weapon rather than a neutral financial tool. Enter the BRICS Plus back. This alliance of nations now holds massive economic weight, controlling roughly 42% of all global central bank foreign exchange reserves. This network map illustrates how BRICS is building parallel financial plumbing. Instead of routing through Western networks like SWIFT, a rapidly expanding web of alternative nodes bypasses them. However, as we zoom out to view market sizes, the economic reality becomes clear. Immediate, complete de-dollarization is highly unlikely because BRICS currently lacks the massive consumer base and deep external liabilities of the United States. Global exporters still need the U.S. consumer. The dollar's monopoly remains intact today, but its foundation is cracking. Nations are preemptively hedging their bets before the legacy system fractures any further. This brings us to sovereign hedging, the emergency playbook for nations that cannot completely abandon the dollar but refuse to remain entirely dependent on it. Central banks in emerging markets are executing an aggressive pivot toward hard assets. They are hoarding physical gold at historic conviction buyer levels. The result of this massive state and retail demand is a historic price surge. By early 2026, gold reached $4,600 per troy ounce. This diversification also extends to digital assets. Corporations and states are purchasing digital gold, with the establishment of strategic Bitcoin reserves serving as a new method to secure independent liquidity. These massive purchases reflect a direct repudiation of the traditional fiat system. They signal a search for liquidity that does not depend on the stability of a single nation's debt. Emergency liquidity is also shifting. As this globe shows, financial lifeline arcs are radiating out from China's central bank. They are aggressively expanding their own currency swap networks to emerging markets across South America, Africa, and Asia, bypassing Western crisis management entirely. The result is a more polycentric financial order. While the U.S. dollar remains the dominant reserve, it is now operating alongside competing power centers that provide genuine alternatives for the first time in decades. This structural shift creates a K-shaped divide for the coming decade. Nations and businesses that prepared alternate supply chains and payment networks will survive, while those strictly reliant on the old system will see their growth plummet. The survival mandate for the 2026 to 2030 economy is strict. It requires rapid fiscal consolidation to manage debt, securing independent supply chains, and pursuing aggressive asset diversification. In an era of constant geopolitical shocks and systemic stress tests, proactive resilience has become the primary defense against economic collapse.